Welcome to Views from the North, a Canadian rates and macro podcast. For this episode, we're going to do things a little bit differently. Last week, I had the honor of participating in BMO's annual macro summit in Toronto. As part of the summit, I participated in a panel which featured James Aitkin, global macro strategist and founder of Aitkin Advisors, Ian Lyngen, BMO's head of U.S. rate strategy, myself, and the panel was moderated by Joe Leary, BMO's co-head of fixed income. The panel touched on a variety of issues, so the topics are a little bit more wide-ranging than usual. I hope you enjoy this episode as much as I enjoyed participating in the panel.
I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated.
For those of you that don't know me, my name is Joe Leary. I co-run fixed income here at the Bank of Montreal. To my right, I have Ian Lyngen, who is our head of our U.S. rate strategy and extraordinaire, very smart man. James, you all know. And all the way to my right, we have Ben, who is head of our Canada strategy, also in competition with Ian for the smartest man at BMO. We'll see who wins tonight. So we want to keep this a little bit lively, and we want to have a little bit of back and forth between the guests here. My job is easy. I got my cheat notes. As those who do know me, I have a very hard time keeping my mouth shut, so I'll try not to interrupt them and give my own views as we're going through. But that said, let's begin. And I'm going to start with the easy one. And I've written questions down on my cheat sheet here, but I tend to go rogue. So let's start with the easy one. FOMC, 50 basis points off the table, wants to bring it down 50-50 for 25 cut. What do you think?
So I'm going to kick this off, and I will give my 2 cents on this. I think that 50 basis points in December is, for all intents, off the table. They were never really going to do it, and the hawkishness that we saw from Powell was pushing back against fully pricing in 25 in December. I know that the odds are currently at 50-50 for even 25, but I think that they go 25, and I also think that as the government shutdown goes on and on and on, probably, frankly, through next week at the earliest before I can envision that ending, that's going to leave that 25 basis points per meeting cadence in place, potentially making January as live as well. So you could get your 50, but it'll just be spread between December and January.
So we walk in tomorrow, and the Bloomberg headline reads, "Shutdown ends." What happens?
So even if we end the shutdown tomorrow, we're not going to get the bulk of the data set for October. Once November's data comes in December, no one is going to trust it because it's going to be so distorted from what happened in October, redo in November. And it's not until we get December's data that we'll have any sense that we have a clear data set, and that's not until January. Even the private data, which has been emphasized, whether it's ISM, whether it's ADP, that can only take the Fed so far in justification, especially if we come back online and we get conflicting data from the BLS. So I think that the Fed is very cognizant of that.
Okay, let's stay here for a second before we kind of move on a bit. James talked about the end of QT a little bit earlier. So there are a little bit of nuances. We did not talk about TOMO. We did not talk about permanent bill operations. We did talk about roll-off of mortgages into the bills market on the secondary. What does this do? What's the implications for short-term rates? What's the implications for spreads?
So in the very near term, it does take away some of the funding pressure, and it's not necessarily because the end of QT is going to completely shift with what is going on in the front of the market. It's more of a signaling thing. And that's what I worry about with, or that I'll observe when it comes to the MBS roll-off being invested in the secondary market in bills. We all know that the risk is that Bessent is going to indirectly force the Fed to monetize the deficit via the balance sheet. And they have set up the framework, or the plumbing, as it were, to allow that to happen if we start to get more and more dislocations and more distortions in the very front end. So I'm not looking at this as a signal that the Fed is seeing something truly dramatic that we're not, but rather setting us up well to avoid any funding strain in the first half of next year, or certainly around the turn.
James, any comments? Ben, any comments on the back of that?
No to 50, that would be very dramatic. Fed's not the least bit hawkish despite what went down this week. I said earlier about the institutional side of it, which is very much on their mind. But yeah, I think they feel they can continue to cut. That's what they're intimating. And they will. But then they've got this thing in the back of their mind like, inflation's still sticky, we can't do too much too soon, we're going to take our own time. And I think they're trying to create the optionality to not cut quite as quickly as the markets would like to price. And on the balance sheet, like, look, as rates and fixed income people and macro people in general, we understand the nuances of how the Fed's balance sheet works. And it takes a little bit of time to get across all the detail. I mean, we all take it for granted, but for everyone else beyond rates and macro and bonds, it's like often difficult to wrap your head around it. And I just bring that up because the Pavlovian response of a lot of people will be, aha, QT is ended, I know what comes next, it's QE. I know that's silly, but that's what some people say. And when it comes to the Fed reinvesting in bills, and everyone will be looking at the SOMA system open market account update and going, aha, this is another form of money printing in QE. So technical nuances aside, which are important, I think generally people will just say, this is great. And that's not great for the Fed, but it might be great for markets.
I heard that they are doing QE and they're solely buying BMO stock.
Yeah, I love it. What took them so long? Yeah, I mean, exactly. It's a no-brainer.
You should get ahead of that. You should. Ben, Bank of Canada, we're sitting down terminal rates around 2%, right? The Fed sitting somewhere in that 3% range. And I'm not going to go into my spiel of why it should be 2.5%. Can that spread stay as wide? And what's the Bank of Canada thinking on the back of what Powell said?
I'm not sure what they're thinking on the back of what Powell said, but they're happy with where they are. That was the message. There's only so much they can do. They've done their job. Guess whose turn it is now? It's Carney's job. His job is to unveil a budget next week that hopefully is ambitious, as my friend to my left seems to think. I'm hopeful, somewhat skeptical, hopeful. You got to be hopeful before you got to give them the benefit of the doubt for now. And that's where we are. It almost feels like they kind of had a conversation. Hey, Tiff, we used to be buddies. You were my number two.
They're very good friends.
Well, you were my number two. Something's coming, buddy. This is your chance. Maybe inflation's a little sticky, which they said in the statement, which is fair. Mr. Jeff Olin loves to rant and rave about how inflation's way too high. I can't disagree. And they've they pick and choose their inflation metric they like, which I'm not really comfortable with, but at least they've admitted that inflation is a little bit sticky, and they're done for now. They've done everything they can do. So if things go pear-shaped, we go off the rails further, yeah, they're happy to do more, that's fine. But for now, it's in the court of fiscal policy, and we'll see what that brings next week.
So I think James and Ian alluded to this a little bit, saying that maybe it was more technical for Powell to get that 50 basis point cut off the market's mind. So maybe I'll throw out there, and on the back of inflation, Ben, Powell wasn't really hawkish, I'll say. He made a really dovish statement. He said that inflation is actually 2%, and it's at their marks, except there's this tariff component of it, and it's a one-time move. So Any reactions to that? Powell was actually really dovish on the back of what he said about inflation.
Sure. I mean, they also said they're going to neutral, so with that 3%, so there's still obviously downside for the Fed. I'm different from probably Ian's view on inflation. We can happily debate that. I'm way more bullish on inflation. I see secular inflation pressures. I don't see any other way, personally. I mean, all the stuff that James had talked about, decoupling, global trade. I wouldn't say like a reversal of globalization, but not a continuation of globalization. That's enough for me to say that the headwinds on global goods prices are not going to be there the way that they have been for the past 25 years. So even if goods prices rise 1% a year, 1.5% a year, that's a lot more than the zero it's been for the past 20 years. And you still have services at 3%, you're not at 2%, guys. Like that's not where we are. So good luck getting to 2% with rates where they have been. They'll have to be notably higher. You'll have to be much more restrictive generally. Neutral ends up being higher. I'm far more concerned about inflation. Powell can say what he wants, but medium term, I'm.
Why do we care about
worried.
2%?
Someone else got it.
That's a great question. I mean, what is it, 55, 56 months in a row where core PCE in the United States has been above the Fed's target of 2%. There's the story. It's like, yeah, whatever. Oh, but long-term inflation expectations are well anchored. Dude, they're anchored because every inflation model on Earth says inflation will return to target. That tells you nothing.
Taylor rule.
Models are wrong.
You know, and so it's like looking in a mirror and saying, don't I look handsome? And because...
I mean, you do look handsome.
Thank you. And love BMO. And where was I? Oh, yes. So the Fed says, long-term inflation expectations are well anchored. Like, can you think of a more convoluted inflation indicator than 5-year forward, the Bryan Sack Index? And, you know, Draghi took that to the edge. It was great. But it's like, guys, that might not contain as much information as you think, which I think is your point. So it's a good question. I mean, why 2%? Why this obsession with it when implicitly we've abandoned it?
I could give you a lecture on economics, but I'm not going to. But it's the lowest number that they think is sustainable without breaking things. That's the actual
Isn't
answer.
it more important the change of the change rather than the actual change?
Yeah. I mean, it's equally important, I'd say.
And I guess the one thing that I would add to this is we're coming out of a couple very, very unique episodes for inflation. The pandemic created a supercycle for housing inflation. What happened? We had an event that made living in densely populated urban centers extremely unattractive. So people moved to the first and second ring suburbs. They get out there, they realize that there are no homes. They bid up housing prices. There's a supply shock on the auto side. All of a sudden, you're in the suburbs. Now you need a car or a second car. You bid up auto prices as well. There's an 18 to 24-month lag in the move in housing as it translates through to the Fed's preferred measures of inflation, whether that's right or wrong. And I think a lot of the underlying argument isn't whether or not we're going to get back to the Fed's 2% definition of inflation, but rather whether that is truly 2%. And I agree, it's not 2%. It turns out when you're in charge of the data and you can make the rules, you can make it say whatever you want it to say. I know in reality, the experience of inflation has been much higher. And the other aspect of it, and I think that this is what, as market professionals, we tend not to fall victim to this, but certainly the average household, the average consumer, falls victim to the fact of people responding to prices in outright terms. They're not responding to the trajectory of inflation. And then the one last nuance that I'll add is we haven't seen the trade war play out the way that the market expected to from a reflationary perspective. In fact, there has been pass-through. There has been moments where where core goods ex autos printed June, for example, much higher than we were expecting and moderated the following couple months. That doesn't mean, like, I can envision a world in which tariff pass-through is 100%, but it didn't happen in 4 months or 5 months. So if it's spread out over the course of 12 or 18 months, it turns out it's not the same event for the consumer. It's not the same event for the Fed. And the Fed can be justified in looking at the employment market and saying that's forward disinflationary. And so by the time tariffs finally make it through, we're going to have the drag of the employment market on the other side. So I'm clearly the Fed apologist on the roll, but I do think that they're not that far off the mark.
So as the dumb guy here, I'll say that I think credibility is probably the major impact, right? They said they have to get there. They can't do it halfway through the game and say, we're going to change the rules. I'll also just add, since I can't help myself, you said a bunch of things about average inflation. I think inflation now more than ever is very different between who you talk to. The top quartile are savers nowadays. The bottom quartile are still debtors and borrowers. The top quartile with high rate interest rate environment actually probably have deflation, potentially, whereas the bottom wealth tier is probably still massively even higher inflation than that 2% average. How is the both fiscal and the Fed thinking about that widening wealth gap?
So I'll start with this one because I think it's very important because it is a definitional issue for the Fed. Who is the Fed? Is the Fed the central bank to every household, every quartile in the U.S., or is the Fed the central bank to the top 10% of consumers? Is the Fed the central bank to the stock market or to the real economy? And I think that they will say, at least in public forums, that they are the central bank to everyone in the U.S. And that's why a lot of the rhetoric that came out post-pandemic when inflation was taking off was actually focused on the bottom two quartiles and the experience of people who were effectively spending everything they make to be chasing inflation. And when we think about the breakdown of households, the bottom 50% are net, you make the point, they're net debtors. They tend to be renters. They tend to have no beneficial ownership in the equity market. So they've missed out on all of the asset price appreciation. The one thing that they did have before the pandemic was that the expansion had gone on long enough that we had finally started to see wages for the bottom quartile start to increase. And that obviously increased during the pandemic as well. So I think that the Fed is a bit more, will take a less top-centric approach.
Well, of course, for all of us in markets, the Fed's all about us. All day, every day. They wake up thinking about swaption skews, rates fall. But they've got a heck of a problem because politically it seems that intergenerational wealth issues are rising. K-shaped economy is real, particularly in asset markets too. And yet the Fed, whenever asked about financial conditions, however spurious they may be, because let's face it, it's just spreads and stocks anyway, so it's reflexive, right? But make no effort whatsoever to say that there might be a bit of froth or excess speculation in anything, which gives people even more confidence to take risk. And that's the reality. And when you're operating in a political environment where the president runs a real-time opinion poll based on the S&P 500 every day, it's very hard to say anything that might suggest that asset prices are a bit exuberant or anything like that. So here we are. So yeah, it's look, the problem of averages, I don't quite know how to answer it, but the idea that this central bank is ever going to act forcefully to skew the benefits of all of this back to Main Street and away from Wall Street is like, I think the probability of that they're going to do it is very, very low. And that's the problem.
How do they do that? Is that in their... So like in Canada, the Bank of Canada has no impact on stocks. Whoever thinks they do, I'm sorry, you're wrong. I apologize. This is the federal government's purview. Like not stock-wise, but the wealth dispersion and fixing that in Canada is a government issue. That's why we pay 54% tax at the margin. That's not an accident. That's how it's designed. The Bank of Canada does not deal with this. They kind of deal with inflation, at least they're supposed to. I don't know how the Fed's going to solve any wealth issues, and what are they going to do?
Well, I know how they could break it. If they follow Mickey Bowman's advice and start shedding agency MBS, man, that would be an exciting day for us all, wouldn't it? That would be a very exciting day. But, if that's what she believes, which she does, she's got a tremendous political cover, right? And she's very political as well. And she goes out and gives a speech and says, we should hold no agency MBS. I'm like, show me. That would be an interesting development.
Does that help? Does that help narrow the wealth dispersion? I mean, it
No, but it
kind of
helps.
crushes some people, but it's going to crush everybody.
Well, probably the net capital gains on people who understood AI, they probably have a 10% down day on top of 1,000% up. So the answer is probably not. But, it'll be an interesting experiment, put it that way. But I know what you're saying, and of course you're right. Is the Fed going to go out and do a Volcker or a crazy Ivan or whatever we want to call it? No.
Even if they did that, you're just going to cause a deep recession and crush the people at the bottom as badly as you crush the people at the top.
Depends.
It does not solve the problem.
Depends whether fiscal policy is available in any way, of course, as you know. But yeah, it would be an interesting experiment, and in a central bank that's afraid of their shadow a bit at the moment, not one they're up for.
And Joe, since you wanted some debate, I'm going to take the other side of your comment.
Go ahead.
You said the wealthy people have deflation. I'm going to go the total other way. Because you're seeing so much wealth increase, because you're seeing stocks rise the way they are, because rates are as high as they are, because you get returns on that as a higher wealth individual, that enables you to purchase that much more. So your spending power is going up faster than inflation. So you just don't feel the inflation the same way the lower income people do. That's all it is. It's not that there's less inflation. It's that your wealth or income, and more likely wealth than income, is rising at such a rapid pace because
Semantics.
Everything, well, sure, but I would characterize it differently, was my only point.
Okay, so I know Lawyer Logan solved everyone's problem. So tri-party general collateral. That's rate. That's the one we should focus on. But I want to move to Canada a bit. Issuance budget. Why doesn't Canada issue a lot more bonds?
Why don't they? They want to maintain their AAA. Simple as that. That's a clear message from them. For now, that doesn't mean more isn't coming in this budget. They don't have to if they don't want to. There are options. They can buy fewer CMBs. I don't think that's going to happen, but that's an option. There's a lot of different things they could do. There's a lot of non-budgetary outlays that they have that involve it. It's over $100 billion in cash. They can move stuff around. So if they don't want to issue more, they don't have to. If they do, it'll be T-bills, 2s and 5s. They've all 2-year and 5-year auctions have gone amazingly well. And then T-bills, the Bank of Canada is going to start buying. Probably post-budget, I expect to see some kind of announcement in the 2 weeks afterwards. That gives them, let's say the bank buys 10%, you got $30 billion right there. Plus you can get another 25 to 30 in 2s and 5s. Like, if that's not enough money, we have a problem. I don't think it'll be more 10s and longs. They've made it pretty clear that that's probably not the direction they want to go in. And if you look at the way the auctions have gone, the 10-year and the 30-year auctions have been way more challenging. They have not been nearly as strong. And so that's just not the direction I think they're ready to go in now. There may be a point in time where they do need to do more, and they're a little less concerned about their rating, but you don't need to break that glass just yet. I think that's a future problem. Hopefully we don't need to see.
2 cents. One thing in Australia, and I regret you tell me the answer here about the depth of provincial markets. But one thing that started this year, which is a function of somewhat wider spreads, is global reserve manager demand for Aussie semis, so state government debt. And that's new. Is there scope for global reserve managers to buy more provincial paper? I really don't know.
Do you want the honest answer?
Yeah.
Yes. They're already buying. They're already well into this market. A number of global central banks are very active in the provincial market. I was in Asia last week, and I must say there was, especially in Japan, I'd say a much more constructive attitude on Canada in general. And so it appears, for a whole bunch of reasons. One, spreads are globally tight, and the bank's cutting, so that makes the 3-month hedge ratio that much more attractive for the Japanese investors, so that part's positive. But it's also a realization that maybe they just don't want to be as exposed to dollars as they were. And so maybe Canada looks all right. It's right next door. It's kind of similar, pretty safe, very stable, good prime minister, wide provincial spreads. What's there not to like?
You mentioned a couple of things, which is why I disagree with you. I don't think that increasing the amount of supply will decrease the potential of rating or increase the yield spread for particular governments that are stable, that have a great central bank, that are using that money responsibly and so on. Look
responsibly.
Yes.
You made an assumption there. And so the assumption is that they're going to spend responsibly. So I agree with you. So they could spend, the deficit could be $150 billion. If they spend it right, I don't care. If we hand out more money, that is not the way forward. So it is, you're making an assumption that, I mean, the past 10 years, you can't make that assumption now. I'm hopeful that that's the way we go forward. Very hopeful. Especially James has given me a little more hope. But if we don't, that's the problem. If we do, I agree. They could issue tons more.
What about
Doesn't
Italy?
matter. Italy?
BTBs have actually a liquidity premium that's going on based on their debt to GDP ratio for where it should be, right? And there is some larger liquidity premium for bigger bond markets, given that there is need to invest globally, and people do want to expand outside of the dollar. The USD has it, Italy has it, Japan has it. Look at Japan's debt to GDP, and their swap spreads are super tight, if you consider that their credit spread.
Yeah. The Italian thing, they are, just by way of reminder, the craftiest debt management office on earth. And they have been out of necessity for 35 years. They had to. That's how Draghi became Draghi. He learned his chops working in the Italian treasury. And they know how to move mountains of money, and they always have. And they have a charismatic leader who's on very good terms with all her global peers, particularly outside Europe. But she's doing a great job because she's brought stability and an element of credibility. Other added benefits, large domestic pool of savings, of course. But their craftiness and their ability to get stuff done is extraordinary.
Domestic buyers.
Yeah, largely domestic, but exactly that. And, you know, they're comfortable with it. There's tax advantages and everything else. But also, let's not forget, she's benefited quite a bit from European transfer funds and COVID funds and huge amounts of money that have drifted towards Italy, a big chunk of which, last time I checked, have still not been spent. So she's doing all right, but I'm just not quite sure it's the template for everything. But I know you know that. And on Japan, it's like, oh man, if they ever demonstrate credibility, then potentially there's an enormous trade to be done in the long end of Japan. Of course there is. Now, maybe there's one already, and we can swap it into dollars and get a nice pickup, and that's fine if we've got a fully funded balance sheet, and there's people been doing that all year. It hasn't quite worked, but it could get right. And you've got a central bank that's sort of chasing itself all over the place, and you've got a Treasury Secretary giving them political cover to hike rates, and they're still like, oh, we don't know what we're doing, which is probably not going to help the JGB market.
So let's switch gears a little bit. Genius Act. What does that mean to you? I think there's more to it. So
I think it's a disgrace. I think it's an absolute disgrace. And I read the headlines about a pardon of CZ, what he did for World Liberty Financial, Trump's coin, and I'm just like, what is this? It's shocking. Now, on the one hand, if I'm thinking in strict national security, the Genius Act is a necessity. There's no denying that. It's related to AI and everything else. But the rest of it, I just don't get it. But that's the nature of the game. And I am old, and as our three teenagers remind me, can tend to be grumpy from time to time. But my view of the Genius Act and the promoters of it and everything else is very, very simple. I've been in financial markets for 35 years. And unfortunate nature of finance is, unlike you all, I'll be very clear, unlike you all, when you work in markets for a long time, unfortunately you do tend to encounter some dreadful people. And it's interesting to me, and I'll say that diplomatically, how many people involved in all of this Genius Act, stablecoin and everything else, all these crypto promoters and everything else, are some of the worst people I ever worked with. Ever. And I want nothing to do with them. So I look at this with like, all right, this is the reality, this is the game they're playing, this is what they want to do, all right, I'm not going to pick a fight with it. But then I look at what's actually happening around it and I'm just like, what are you doing here? This is just unreal. And how it restores confidence in the US's ability to manage the dollar, the fiscal situation, debt and everything else, I have no idea. And suffice to say, no emerging market country on earth, and quite frankly, not many developed market economies are keen on the idea of creating dollar stablecoin guardrails around the world which makes it easier and easier for citizens to get out of their home currency and flick it into some kind of dollar stablecoin thing. So I have great reservations about all of it, but they're doing it, and frankly, what I think doesn't matter, and that's a pity.
So,
Top that.
so on
I
that,
have
I
some
think it's a
comments.
great idea. I don't know. It's an idea that's time is long past. So I think that the Treasury Department is doubling down on the idea that stablecoin is going to unleash a ton of demand for the bill sector. And I share your cynicism. I don't think that comes to fruition. I don't think there are enough medium to lower income people around developed markets, developing markets, or in the rest of the world who are going to use their app to buy stablecoins in a way that's going to fund a $2 trillion deficit in the bills market. Sure, we can go from 200 billion to 300 billion over the course of 12 to 18 months. Yes, but I don't think that it is going to be the big windfall that the Treasury Department and the administration has been promoting it as. So I share the cynicism. I guess I'll argue it is an extension. It's an extension indirectly of the debasement trade. It's an extension of an attempt to move away from fiat currencies into commodities effectively. But I don't think that it's going to solve more problems that it creates.
So I'll take the other side. I think that and by the way, the execution of this may not work, right? The idea though is to own the rails, right? I don't think it's about stablecoin. I don't think it's about crypto. I don't think it's about anything about that. They want to make the rails dollar denominated. It's meant to put a floor on the cheapness of the dollar, such that things, in order to go to the next level, it's the modern version of ACH. It's the modern version of Visa or credit card. And if you own that within your currency, you are putting a floor on the currency itself, and then therefore can issue more without getting that premium that's going on through that issuance that you alluded to possibly for.
That's a
the
fair
cats.
point. No, that's absolutely how they think about it. There's no denying it. There is also a related plan afoot, and there's a lot of crazy things flying around, but there is a related plan afoot to retire the entire stock of US Treasuries on the back of all of this. And serious people are working on it. I'm like, you're going to retire the entire stock of Treasuries? Yes. How are you going to do that? Well, we're working on it. Okay, what does it mean for all these global markets if there's no Treasury collateral? Don't know. Well, you probably got to do a bit of work on that. But there's all sorts of ambitions, and you're dead right that maybe my cynicism is entirely misplaced, but that's absolutely part of their thinking, is the guardrails.
So you mentioned AI funding before. We saw today come through, Meta brought I think they upsized it from 25 to 30. I didn't look, but I think it was a $30 billion long-term bill. Where did it come at, Tom? I don't know. IG credit level to fund something that doesn't exist yet, a new venture. So how do you think of that kind of spread between startup funding and actual funding levels that people are getting for AI ventures?
I'm no expert on the AI part, but I mean, it's just indicative of where we are globally and where risk assets are, and stocks go new highs every day. The Fed's cutting into a pretty strong economy. Global central banks are cutting. There's plenty of liquidity. Spreads are all tight everywhere. Provy spreads are at their tights. Pick a spread. It's at its tights. Why wouldn't these be also at their tights, even though we don't know? Does that mean it's going to end? I don't think so.
That's it. And, hats off to Meta's Treasury for saying, you know what, let's go. After earnings that were a bit of a disappointment to some people. All right, let's go. Let's remind people who the big kid is. Bang, and off it goes. Flies off the shelves, so to speak. Oh, great. Let's do some more. I'll be back.
And the other thing that it does is it brings in a different investor type. Right, so you have it. It's no longer equity. It's no longer private equity. It's like, oh, now I'm in the bond market and I can get involved. So they're tapping that as well, which is again brilliant. It's a good way to start the buzz.
And just to be a party pooper for a second, there's a slight distinction between Meta Holdco or Opco issuing paper and an SPV that they set up off balance sheet with PIMCO and Blue Owl. Who gets the cash flow of all this stuff that they're trying to build? I haven't had the time yet, but I'm very interested to read the full prospectus of recourse and everything else on cash flows. But I don't doubt, to Ian's point, that the demand is there. And the genius, if you will, to use that word again, of Meta shopping that 29 billion originally of data center loans was that you could structure it to give investors a pickup because there was some trick to it which they'd figured out. And of course, people think, oh, you mean I can get Meta Plus, so to speak. I'll have all of that. So it's fiendishly clever to watch this. And just, you've reminded me something I forgot, forgive me, about OpenAI and Sam Altman. I mean, look, if we were all trying to raise $500 billion we didn't have, we'd have to be pretty creative, right? And what this guy is trying to do is so deliberate, why these funding rounds, which get more and more strange, but now we've arrived at a valuation of OpenAI of $500 billion, ahead of the IPO, which is going to be, pick a big number next year, $1 trillion, against which he's going to borrow $250 billion. And he understands collateral value. He understands exactly what he's trying to do. And he's getting away with it. That's the story. He's getting away with it, which is a remarkable thing.
All right, so I just want to ask each of you, how does all this blow up? What are you concerned about?
Well, I'll start with that. I got a lot of worries. I'm in the bond market. So I think that what the central banking community has generally been able to do a very good job at is taking the ebbs and the flows out of the cycle. Not too high, not too low, not too high, not too low. And what occurs is we create pockets of value stress. And we thought it could be sovereign bonds 12 months ago. We think it could be equities at ridiculous valuations now. I'm worried about the private side, not necessarily private credit, maybe private equity, maybe some of the commercial real estate, which is effectively marked to convenience instead of marked to market. And there could be a point where that all comes back as we start to see some of these valuations questioned.
It's a really good question. I think the path to a bad outcome runs directly through market structure, okay? Now, we have optimized our financial system to the edge because that's what humans do. We optimize every system to the edge. And it's no different with financial markets. And you think about all the prices that are streaming all day long, and you think how few of them are actually a human on a phone, which reveals how old I am. But you see the point I'm making. We've optimized everything. BMO is providing liquidity across a range of asset classes, a range of tenors and everything to their clients because that's what the clients want, and you do it, requires an investment, you do it. But then you've got all these other people who are the best bid on offer on every electronic dealing platform on earth. And how they, this euphemism of PTF, because it sounds so much better than HFT, but it's still HFT, right? So it's a bit of a branding change there. But they are streaming all these prices by the millisecond. That's what they do. And they have no interest in you whatsoever. They don't. They're in and out all day long. And they all claim to have different algorithms, but they're all quite the same. And they'll be making a bid offer in 10-year note, 5-year note, future or something like that. And they see something and there's a sudden increase in sell orders. So they widen the bid offer, they keep getting hit, they go down again, they keep getting hit, they widen. Oh, hang on, we now need to lay off the risk in correlated instruments, so they go back the Bund, the machine. This is all happening by the millisecond. And most of the time we don't notice it. But the other thing that's caught my eye the past couple of months is not the plumbing, it's not the mini flash crashes, it's the incredible churn under the surface of global equities, all the factor stuff, right? It's unreal. And I spent a lot of time looking at that and I'm like, that's out of control almost. I mean, it sounds strange, but something's not working there anymore because there's so much flow trying to trade in and out of factors or thematic baskets. You've got the sell side. I don't mean yourselves, but some of your competitors have gone to extreme lengths to replicate their client flows via quantitative investment strategies or QIS. So we've got all these replication strategies and copycat strategies, which I think about a lot. So if I'm imagining a really bad outcome, I think first and foremost about a negative wealth effect that severely impacts consumption and that for a period of time, due to structural reasons, risk distribution and intermediation is impaired, not just for an hour or 15 minutes or even a week, but it becomes sustained. People notice, they hunker down, it becomes self-fulfilling, and it's not then an issue of fiscal policy or monetary policy or standing repo facility, it's an issue of pure market intermediation. And in the effort to drive profit, which is absolutely rational, in the effort to optimize market making and everything else, which is absolutely rational, we don't have many redundancies in the system. That's the thing that bothers me most. I think about it a lot. And, we continue to muddle through pretty well. But when we bring in all these people for the first time to finance who don't read a prospectus, don't care about what the business does, it's just a thing. It's a trading sardine, right? It's a gambling chip. They don't care about anything. It's like all about momentum. Now, momentum is great, as we've seen recently when something you own is doing that. Let's take gold. Everyone's an expert on debasement when gold's at 4,200. They're all a bit quiet at 3,950, but hey, and you're seeing so many things do these rocket ships, and you think, what happens if not one or two much-loved trading instruments like precious metals or a rare earth stock or a meme stock do that? But what happens if 100 of them do it? That's what I worry about. That's what can go wrong to me. So the path to bad outcomes for me runs directly through market structure. And I spend a lot of time thinking about that.
I would ask why. You both laid out things that could go wrong, but why would they go wrong? What's going to cause that? What's the trigger? I think
cyber attack.
That's stuff like, so that's an answer. Definitely, that would be a serious problem for everybody. Outside of those black swans, I can't predict those ones. Think about valuations and people worried about equity markets and spreads, and what does all that have in common? Like, what impacts those? Where do you get to the point where you're like, hold on a second, this doesn't make sense anymore? And I don't think it's because the prices get too high or the spreads get too tight. It's because rates move too high. Real rates are too high. This discount rate is now wrong for where the asset price is. We have a problem. This is where I think there's a much bigger issue. The market doesn't care about U.S. fiscal right now at all. Great that the deficit's at 5%. If you're growing at 6 or 7% nominal, that's fine. Exactly. Until there's a problem in the U.S. What happens when they have a recession? And every party loves to spend. And the deficit goes to 10. What happens? And nominal GDP growth ain't 6% anymore unless you blow up inflation. But then what happens to the long end? That is my concern. That kind of outcome, that kind of sequence of events really is what I'm way more concerned about, because there's no pushback on deficits. Somehow there is no realization that all of this leads to inflation and what that does to the long end. And we're just in a place where if something bad happens, there's not that much of a buffer. The Fed comes in and buys a ton of bonds like, oh, we know what happens when we just did that. That didn't really work out for everybody, did it? Do we want to do that again? Probably not. I think the market's going to realize that. That worries me. That's the trigger for all these things. That's my way bigger concern.
All right. With that, I appreciate everyone's attention. Thank you, Ian. Thank you, James. Thank you, Ben. Very insightful. Hope everyone enjoyed it. Thank you.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.